Now that you have a trial balance, I'm going to show you what you can do with it. In any business, the financial statement is the document which provides a summary of the current financial status of your home or business. You can compare your financial activity of one period of time with another to be able to tell how you are doing. It will also be useful to provide information to banks or other financial institutions when obtaining a loan. You may have already been requested to provide a financial statement had you purchased a house or a car. The function of a financial statement is to provide a summary of the current financial status of your home or your business. This enables you to know how your business is doing. And finally, it provides information for loans or to other financial institutions. There are two reports included in the financial statement. The first is the balance sheet. The balance sheet is a snapshot of the financial status at a particular day in the life of a financial entity, whether it be your own life or your own business. The balance sheet shows what you own and what you owe at a particular time of date. This is the balance sheet for the ABC Medical Clinic. As mentioned, it's of a specific date, that is 12/31/2015. So that on this date, this is the status of the medical clinic. Notice the assets. Checking account. The checking account contains $153,000. There is a savings account. The office building is worth $450,000. Vehicles $66,000. Equipment $225,000, as well as furnishings. These numbers reflect directly back to the trial balance which you have already seen. Accumulated depreciation simply means that as things are depreciated, rather than changing the value of the building, for example, each month, the accumulated depreciation gradually increases till it matches the original cost, at which time the building would be worth nothing. The assets are summed, which is $861,171, and we have the total assets. The liabilities, as mentioned, are things that we owe. For example, the office mortgage still owes $375,000, a business loan of $250,000, and payroll taxes due. The total of the liabilities is $638,000. The owner equity is a little bit more difficult to understand. Basically, it's the difference between the assets and the liabilities. For example, if you have a house that's worth $300,000, you've paid off $100,000, and you have $200,000 left, the equity on the house is $100,000. Looking at the equities, the equity of the business is $123,000. Retained earnings is the amount of money gained from the previous period. And loans from shareholders is that you invested $100,000 in the business when you started. So the owner equity is $223,000. The total liabilities is $861,000, which balances with the assets. A positive equity means that there is value to the business. A negative equity means that the business is bankrupt. The importance of the equity to a financial institution is this. In the case of this business, the bank might be willing to loan you another $255,000 because if you go bankrupt, there's cash available to pay them back. If, on the other hand, the equity is zero or negative, it's very unlikely that they'll even talk to you. Now, let's turn to the profit-loss statement. The important thing to remember with this statement is that the time interval of the income has to be the same as the time interval of the expense column. If one is in months and the other is in years, then it makes no sense. However, it is possible to use multiple time periods, such as the month and a month a year ago. Remember that the profit-loss statement is dynamic. It takes a certain amount of time for money to come in, and it takes a certain amount of time to spend it. As shown, the profit-loss, that is, the income to the business, equals the income minus the expenses, a concept I'm sure you're already familiar with. A positive result means that there is a net income to the business, and if negative, means that there is a net loss of money to the business. Now let's take a look at an example of a profit-loss statement. This is an example of a financial statement for our hypothetical business, the ABC Medical Clinic. Notice, as mentioned before, there is an interval that the report refers to, that is between 12/1/2015 through 12/31/2015. Notice that there is an income column and an expense column. The income to the medical practice for the month is $93,000. Interest on different accounts is $2,200, and miscellaneous $223. Note the practice had a refund, $1,200. So the total income for this period is $94,000. Notice the expenses: insurance, MD salaries, employee salaries, and so forth. So the net income is equal to the $94,000 minus the $66. So the net income to the clinic is $28,000 for that period. Of course, this is a quick summary of financial statements. Obviously, in any real business, there are considerably more sources of income and more sources of expense. This is just an example. The important thing to remember is that the balance sheet occurs on a specific date and is static. The profit-loss statement always occurs over a period of time, as I mentioned, because it takes a certain amount of time to earn money and a certain amount of time to spend it.